Hello, my name is Dr. George Mochocki, and welcome to Management 218 Corporate Finance. Today, we're going to be discussing Chapter 11 Risk and Return in Capital Markets. You're taking me online, face to face, or blended class, so you just happen to stumble on this on YouTube. Please enjoy. This is a course that's offered at a community college, so it's a basic understanding of what we discussed in our lectures, our discussion boards, and in our forums. Make sure you read the book. Look at my Pearson has good. The book will help you to do the mechanics or the math portion. But at this level here, since it's an introductory class to corporate finance, it'll give you the basic understanding of the terms and the concepts and how do we able to apply them. That's why in my courses you'll do article reviews, current articles. You look at them, we'll discuss them, and then we'll tie the chapters reading so you could see here's what's going on and here's the application. And once you understand the applications, you can see what other your competitors or other investors are doing, and or sometimes you can say, hey, maybe this will work for my organization and my structure. Remember, your final project will be taking a company that we have approved that's already on a downturn, and how you're going to bring that company, the stocks or the value of the stocks up. And this is what this whole chapter, this whole course undertaking is. It's so you could actually feel what it's like to be a chief financial officer. Most of us are mini chief financial officers. Where do I get the money from? Where do I get the capital from? How do I buy a new car? How do I pay for the school? Is it debt? Is it equity? So now what we're going to look at is what's the return on my investments. If I invest in a house, how much return do I want to get back? I don't want to lose money. Remember when the housing market, the bubble came, a lot of people lost money. They paid more than what the value of the house was. Even though here's the value of the house, it's only worth 75,000, but the market value was 200,000. And you go, hey man, that doesn't make sense. But you paid that 200,000, and hopefully you're going to turn it around. But it crashed, and it was basically here's the actual value of the home. So what we're going to be looking at is what's going to be our return on our capital investment. Remember, our capital investments could be anywhere from 2 to 10 years. So 10 years is a little harder to anticipate, but you're always adjusting and looking at your investments to make sure this is the right strategy, or should we modify it? That's part of being finance. Remember, accounting, the numbers are coming in. Just give me the regular numbers. Here's what actual what's going on. Here's where you're at right now. You have to look in the future. So you're going to say, okay, I've got this. In the future, I want this much money, but I got to discount it back to here. And how much money do I put back in? Looking at inflation and other outside or internal forces. All right, so let's go into this. I'm going to try to keep it under 20 minutes. Remember, use the books, use the YouTube, the lectures, everything else. This is a summarization. So if you understand this, say, Dr. George, I understand what you're talking. Get the book, read the book, or take a class at your local community college at this level. When you're going to go for your bachelor's and your master's, they understand, you know, the conceptuals, what's going on, and now they're going to go into more detail or more different factors affecting it. More, let's leave it at that for that one. Otherwise, I'll make it too complicated than what I want it to be. All right, so we've got 20 minutes. I'm watching my clock in here. I'll try to keep this under 20 minutes. I know these things popping up, but sometimes I get my odd blocker in there. Okay, so we're going to talk about the first look at risk, computing historical return. Remember, in finance, when I'm looking at something, I'm doing something, I gotta have a baseline. I look at historical data and I'm trying to make assumptions of what's going to happen in the future. So I look, hey, look, I used to weigh 130. Here, could I get that? No, but I think I could get back to 170. All right, so you're looking at historical data, but you have to have a point in time. Here's where I'm at, and now going forward, I want to change these numbers. You got to have some kind of baseline that you're comparing to. Okay, so you're looking at the historical trends, trade-offs between risk and return. Remember, we talked about higher risk, lower risk. Again, we're going to talk a little bit about systematic risks. We'll be talking in other chapters and unsystematic risk. Remember, systematic risk affects everybody. Unsystematic risk, it just affects my industry or my company as a whole. Common versus independent risk, and I think that's about it. Oh, And maybe I'll get it done lower than 20 minutes. Those who've had me before, I don't edit anything else. This is just like you would have me in a classroom. I just go on with any kind of questions. I'm just going forward. This is just a quick summarization. Read the book, look at the YouTube, and look at the Blackboard course management system. I pick select different YouTube that will kind of help you the concept from a different perspective. So if you're taking this class and everything else, and you're getting a workbook, the workbook basically is provided by another author other than the one who created the book. So if you don't understand how he or she's presenting it, you could look at another author and say, "How about this way? This is how I look at it." And between the two, so when you said, "Sure, I need the workbook," it's not usually written by the same book. Some students want the workbook because it's another perspective. So I'm just trying to give you this quick overview, make it simplified, and bring it down to what you need to know. Okay, so let's look at this. I got it at 200. Remember, you can move along, take my concept maps that are provided to you in Blackboard or in the classroom, and you add on to it. And look, when you're reading the book and you're reading it, use my concept map and add on to it. And then when you look at in discussion, add on to it again. Oh, I missed this, I missed this. And then when you're taking this summarization, oh my God, I forgot about this. And if you're not sure, go back in the book and reread it. That is how you're going to learn. You're not going to get it a one-time deal in understanding everything. All right? Okay, so first look at risk. Let's see what we have here. Okay, Standards and Poor's, right? That basically is leaders and largest firms. That gives you, it's an index form, for lack of better words, out of the top 500 countries. Companies are performing overall, gives you an average, so you know, okay, where's it at? So you have a general idea. You got something to look at to see it might be lower or above what my return I think is going to be. Okay, your small stock. Now, small stocks is a little bit different. Updated quarterly. Of U.S. stocks traded on the New York Stock Exchange with capitalization in the bottom of 20%. So it's not doing the higher ones, it's doing it the lower end. And again, when you look at the New York Stock Exchange, it's usually the bigger stocks anyway, but smaller compared to some of the larger ones. But it gives you just a quick like a pulse, for lack of a better word, what's going on at that time to see am I getting the same return as some of these the blue chips stocks, for lack of better words, are performing. Okay, the world portfolio. Now, this one here is a portfolio of international stocks of all world's major stocks in North America, Europe, and Asia. That's another indicator. Remember, we're in a global, I'm not saying we're globalists. We're in an international thing. We operate globally. We still may be nationalized in the United States, think about our country, but we look what other countries are doing, and that could be effect on us. If our country, we're not getting a good return on our investment, I invest in European Union. I invest in China. China, right? China's having a little trouble because of the trade embargo. So that's an indicator. Maybe I don't want to invest in China. But there's other, maybe Asia. Maybe, when I look at China and Asia, maybe in India, or maybe I do something else, maybe Vietnam, or other countries, or South America. These are things you're looking at when you're looking at the world portfolio, what's happening around the North America and Europe and Asia. And so I get a pulse. It may not happen here, but it will trickle down. I have to see what the trends are going. That's part of finance. You're always not, you just wake up what I'm going to do. You're always looking at the markets. You're looking at what's going on. What's Trump doing? What's the Chinese leader doing? What's happening in Venezuela? How's it going to affect me? How's it going to affect the oil? All these things, depending on the industry or the category that you're looking at, you should be aware of these forces, and you say, should I make a decision? Should I change? Should I keep? Should I buy? And sometimes you're buying when it's low with the anticipation it's going to go up. Okay, corporate bonds. How are corporate bonds doing? All right, a long-term AA rating, U.S. corporate bond with a maturity of that's approximately. Let's see if I have approximate 20 years. Remember, I edit mine as I go. Remember, I'm live, and so if I make my mistakes, I utilize these concept maps because it's a quick way of covering, instead of going 20 PowerPoints, I'll be here forever. Just highlight. Remember, you'll read this, I don't understand it, get more information. These are triggers in your mind. Oh, now I understand. And it all falls in. So when you look at this chapter, you see everything that I have to know about risk and returns. Okay, then you got the treasury bills. What's going on? Investments in 1 month U.S. treasury bills reinvested as bills mature. What's happening with the U.S. treasury bills? China's unloading and have a little problem, so they're selling treasury bills. Are they trying to say, hey, we want our money, or do they need that cash since we have the tariffs and then indirectly? Who knows? But do I invest in China? What's happening? What's going on with the treasury bills? Why all of a sudden there's more treasury bills? Because they're selling the treasury bills back to the U.S. Says, hey, we want our money, or they're selling in the secondary market. Okay, okay. Now, when I'm looking at computing historical returns, remember I'm going quickly. I just want to. Oh yeah, I understand it. What the heck did he say? I didn't understand it. Look and read the book. Look at it and find out. And if you don't understand it, get a YouTube. Go on some of the other sites that you have. I've got MBSBS is a good site. I have Yahoo Finance. There's a lot of different sites I provide for you. Some make sense for you, some don't, depends on what level you are. If you're already investing in stocks, you have a general idea what I'm talking about. If you're not, let's find out. But there's other courses. Just don't get it from one class. You're not going to know everything out of this class or other classes. As you take more classes and then you see it in work, you see what the articles and you see everything else, all of a sudden one day the light's going to click on. It's a word for ComEd. Just threw that in there. Okay, computing the average return. Okay, realized returns, total return over a particular time. You always got to see how much I'm going to get at a certain time. Historical risk and returns of stocks using average returns on past data. What's normally the stock? Utility stocks, you're not going to make much money on them because there's so much capital investment, but they're always paying dividends. And it's okay, this is a steady income stream. That's what I want. Tech stocks, higher risk. It's changed, but if they come up with a new idea, I can make a lot of money, but they're very I don't want to say unstable. They're constantly in a flux of change. Okay, some are more unstable than others. Okay, variances variances returns, for lack of better words. Okay, standard deviation. You had that as standard deviation. Measure the risk of probability distribution, square root, and here's the page. Here's the formula. My finance lab also has a YouTube on there. There's other YouTubes I provided. In a nutshell, it's basically a tendency of historical returns to be different than the average. How far from the average? So you're looking at what's the spread, for lack of a better word. I'm not teaching statistics. I'm not teaching anything else. I just want you to understand the common. It's basically the spread from the average, and how far is it from the average on historical returns, what they consider the average. And that could be it. Remember, don't look at you look at the whole industry or different portfolio, but you may be looking just for that company or that industry, the oil industry, or you're looking for the tech industry. What is the standard deviation on that? Okay, common mistakes. Divide by one less number of returns you have. Okay, we talked about that. That's a mechanical or mathematic issue. Just remember, it doesn't start at zero. You got to put the one. Oops, things keep on popping up. Annoying. All right. I just don't want to spend the money for the ad blockers. Okay. Square root of variance to obtain the standard deviation. All right, it's just a general reminder. I think I got a YouTube and a publisher in my finance lab basically explains that a little bit more detail. If you don't know, it's the first time, but you should know a little bit algebra and a little stats and a little basically statistics, basically probability. All right. Okay. Now the variance again. We talked about the variance measures the variability of returns, expected square deviation of returns from the mean. Okay, from the average and far back. Okay, normal distribution. All right, systematic probability distribution of its average by the standard deviation. What the heck are you talking about? Look, when I look at the bell curve, your normal distribution, right? You should have so many F's, so many A's, and the majority of people are going to be in the center. If your bell curve's more here this way, that doesn't mean nothing wrong with it. It just tells you usually after so many times it's going to be in the normal distribution. But sometimes depends on the stock. Sometimes depends on the perception and everything else that bell could be over on the plus or could be more on the negative side, depending on the industry. I'm not getting into that. I just want you to understand. But on an average distribution, here's somebody you've got your somebody low, somebody high, and an average. Here's where a majority of stocks will fall in. Okay, and then the computing standard deviation. Okay, now historical trade-off between risk and return. Remember, I'm looking risk. Look at your credit. If you got a good credit score, you only pay maybe 13% on your credit card. Things are going up. All right. If you got a poor credit score, you're paying 21%, 22%. All right, because the risk, I don't mind taking the risk, but I want a higher return because you're a risk factor. That commodity may be a risk factor. My investment may be a risk factor. So I'm looking at the historical and trade off between risk and return on the investment. Okay, return of large portfolios, return on individual stocks. So you have to look at that, and you're looking at different. It's not that hard. Remember, when you're doing investments, you're looking at the industry overall, then you're looking at your particular stocks or investments you have within that industry. Or if you have a portfolio, then your risk is basically you got the high risk, the low risk, and then you have an average. Like in the classroom, I say I got my A students, and my A students supposed to be on the right, higher up. I got my A students, I got my S students. But in the average, the majority of the people in my class are probably a C plus, B minus. A harder thing. Oh, everyone wants to be an A. No one's going to be an A. Finance is not that easy, but you could achieve it at this level here in my course and a lot of classes at junior college. You should be between a C and a B and an average because we're going to have a little math. We're just you're learning a new language. You're learning a new concept, so you're not going to be as proficient as somebody's going to be in a bachelor's or a master program who already has all this building. Look, before I go into algebra or geometry or trigonometry, I had to know how to add two numbers together. Basic math, then I go up and I take the finite math, then I take algebra, then I take geometry, trigonometry, and then I build myself up. But I had to start with a basic. So we're here as a basic. That's why you do good. A lot of people say, "Hey, I got good in algebra, but when I went to trig, oh my God, I went to calculus, my head is spinning." Not that hard, but do you see what I'm talking about? Because you might have mastered it here, you might have not mastered it on the next level. But so here, you'll do well in this class or any classes you take at a junior college because they're giving you the fundamentals, the understanding of how to do. If you're learning to English as a second language, it's for me, English second language, what happened? You have to basically know how to put two words together. I'm trying to learn a little Spanish. My daughter-in-law is Mexican, so I'm learning, to communicate with my grandson. I learn a few words. It may not be proper sentences like a broken English, but then after a while, as you're taking more classes, now I could connect the thing. I'm beginning to be more coherent and beginning to have more, the sentences have more grammatically correct. My writing improves, but I started from here and I work my way up. So here I was getting an A, then I'm going up, then I'm going up, and as I get more, I should still maintain that, but sometimes I may hit that mental block. I just went too far. We're all different. We all think differently. Some of us take longer to learn the information. Some of us take shorter. Don't worry about it. You'll get it. This is your first intro. Are you okay? Hang in there. I'm trying to be a positive on here. All right. Okay. Common versus independent risk. Okay. Again, theft versus earthquakes, insurance, and type of risk. Again, we're going to talk common risk is basically a link across all outcomes. Earthquakes. You have no choice. Everyone gets affected. Hits homes, damages. I don't care. If you're in that region, remember some regions aren't as prone to earthquake. If you look at flooding, you go some areas of low lying, they're going to flood. You're on the Mississippi River, they're always flooding, so the risk is higher there for insurance. But if you're someplace else more in the plains, very rarely does it flood. All right, you got other risks. You got drought. So you have to. Do you see what I'm talking about? So you understand what the average or what's the common risk that affects everyone in that general area. Okay, now independent risk, for lack of better words, risk bears no relationship to each other. Knowing the outcome of one makes no difference to the second one. Theft of a home. Just because my home broke doesn't mean your home's going to be broken into. All right. Some lucky, some not. And look, my home may not be broken in because I got lights, I got security camera, I got alarm system. I'm just making that up. But you're talking about our other home, they got nothing. Got cheap locks. It looks like no one's ever home. Windows open. So I have a higher probability that home's going to be broken into. Same when you look at an insurance company. When you look at for fire, if you're close to the fire hydrant, say your risk, if you still have the same risk out here, but I could put out your fire quicker than if I'm 2 miles away from the fire hydrant because I have to bring in the water. I could control it. Okay? Now, diversification, and we talked about this, or we will talk, averaging the independent risk in a large portfolio. Right? Like I said in the classroom, we're doing pretty good. I think I'd be underneath 20 minutes. Okay, diversification in stocks portfolio. Okay, unsystematic risk versus systematic risk. And unsystematic risk basically is fluctuates of stocks return due to company or industry-specific news and independent risk unrelated to across the stock. It just hits that one company, hits that one area, oil or tech. It just hits that. But the other ones, like clothing, or things may not be affected by that. Now, systematic risk fluctuates the stock return due to the market as a whole. Recession affects everyone. I don't care what you are. Everyone's affected by recession, unemployment, everything else. If, in a certain area, everyone's affected because you don't have the disposable income. Or the company, let's say right now, if I'm looking at regulation, it'll affect everyone. You know what I'm talking about? In that industry, in that thing, taxes. They said to tax everyone, it affects everyone in the tax bracket. I don't care the color, race, it affects everyone area of the country. They all have to pay the same tax if you fall into those tax rates, which are low underneath this administration. And some people say, Dr. George, you're always talking about Trump. Trump does. Hey, I don't care. Trump does this. This is where we're at. He's the administration. He's doing rules. He's doing regulation. Whether you like it, they say the Trump effect because he's a business person and people think, he knows business. So businesses are going, okay, he probably knows what he's doing. He has some kind of a rationale behind there. He's not a politician. He's that maybe a liberal arts person, has done about business. So do you see what I mean? So whatever it was, Obama, would have been Bush Jr., whatever. You have to look at the administration, what they're doing, and that's what I'm talking. Right now, he is the administration. He's making the rules. He's doing the tax break. He's bringing this back. He's doing the, like it or not, it affects me as a business. I'm taking that as part of my external forces that I have to include into my calculation for what my return is going to be. Because if the tax is going to go up, then my yield changes. That means I got to pay more in taxes. I have less profit that I could reinvest or give back to the shareholder. Right now the taxes are low. People are coming back. So now when they're coming back, manufacturing is back here. I don't have to pay the cost for overseas coming back in here. I have the distribution closer. If I had the distribution closer, I could use just-in-time management because I don't have to worry about the ship coming from or planes. It's usually by ship because it's a larger good coming all the way from China or from Europe or from Mexico's even good. I could bring it in here because it's still on the continent, but if it's right closer, I could get just in time because anything happens, it's right there. But then I don't want to have all my eggs in one area. With the logistics, I got to look outside just in case. What if this is in an area that has earthquake? So I'm going to have what you call systematic risk. So if this area goes out, there goes my distribution. I got to have someplace else. Maybe cost a little bit more, but I got another source coming in case this thing happens or there's a strike or something else. When I say a strike, I'm talking about the union strike or labor unrest or something else going, or a shortage. I could have different. So a lot of companies, they have the main supplier to minimize, right, because they got the best price, but they also have the minor supplier is to kind of minimize risk. When you're looking in management, you can't control Murphy's Law. Murphy's Law, something's going to happen. You have insurance. You call risk management. How do I minimize them? I could do everything I want. I could be a big bubble and everything else, and I could fall off and get hurt, right? Hopefully not, but I minimize it. I fall, I might bounce back up. So you have to be able to minimize it. You can't never get rid of anything risk. Even the most secure areas, something can happen. Unseenable. But I have a 99% chance I'll be safe. And that's what you have to do when I'm looking at risk and return, is how do I manage my return? I want the highest return. Sometimes I got to pay a little bit of insurance in case something does happen. I don't lose everything. That's why you have insurance. All right, so let's see. I think I finished it. There's another one up here. Hang on a second. Oh, but pretty good. Let's see it. Just want to be one of my shorter ones. And remember, look at the book. Don't get too. Right now, you get hung up with a lot of the math and everything else. It looks complicated. I'm just giving you the easier problems. I'm more concerned that you understand conceptually what's going on, and then the math you could do is usually an Excel spreadsheet. I want you to understand what the number is. I want you to be able to pick out what companies are doing, and then you do the math to justify your means, or you're looking at the math or historical trends and everything else to see what's going on. Everything's doing good, but when is it going to crash? Is it going to be a bubble? Remember, everything goes in business in cycles. Just like my, a growth, maturity, decline, and how do I bring it back up? Or do I get rid of that investment and go someplace else? Because that's a dying, when I say dying investment, is people aren't buying it anymore. And coal's kind of go down, it kind of alive again because Trump's doing some things, reducing some of the regulations, good or bad. But then other industries are going, okay, maybe we could do gasification with the coal because technology's in there. But right now it's not doing it because oil prices or natural gas prices are low. If they go up, people start looking, or they use what do you call it? Solar power, for lack of better words, or wind power. If I'm next to Niagara Falls, I've got hydrogen power, hydropower. You know what I'm talking about? From the water. So you have to look at what's the resource, but what would happen if something would crack with the dam? Then where am I going to get my electricity? Ooh, I'm tied up to a network someplace else. I may have to pay a higher cost. Okay, let me just bring this down. Level 1. Okay, so we have everything in here. And let's see how many minutes I have on here. 24 minutes, one a little bit more, but that's fine. All right. So again, my name is Dr. George Mochocki. Make sure, when we're looking at this, it's not that hard. It's not that complicated. What I want you to come out of this class is understand the basic conceptual understandings, and then the rest will make sense. And remember, there's a lot of information. There's 23 chapters. I'm just giving you, here's a little bit, here's a little bit, here's a little bit. No different in tasks you do. You got to do this. You want to fix something, you got to take this apart first, or you're putting something together. They give you the steps, and it looks complicated. Look how big the manual is, but you follow the steps. Oh, it's not that bad. So what you're doing is you're looking at different aspects, and this is all what a chief financial officer does. Or this is what you're doing. You're all chief financial officers at your home. You're looking at risk. Do I buy now to pay my college loans? Do I take a loan? Which ones do I do? Which is the best one? What's the risk? What's the, how could I pay back? Do I look at adjustable, figuring my income's going to go down, up, or do I think my income's straight? So I want more of a conservative, or I'm more of a risk taker. Again, finance. It's all probability. It's all risk. How do I minimize the risk? Again, my name is Dr. George Mochocki, and thank you for signing up for this class. If you can't take my class, sign up for a class at junior college. It'll give you good basic understanding. So when you go for to your bachelor's or your master's, you have that solid foundation. Read the book. Utilize the book. The book, when you buy the book, it has YouTubes, it has videos, it has a math. It's an excellent book. You know what I mean? Just another one. If you're not using Pearson, you could use their competitors. Again, I'll see you in our next chapter. All right? Have a good day. Hang in there in the class. You'll do fine.